Benefits of tokenization. Tokenization offers several key advantages over traditional asset ownership and transfer mechanisms. Let's discuss a few of them. 1. Liquidity. By digitizing assets and representing them as tokens, tokenization unlocks liquid assets, such as real estate or art, enabling fractionalized ownership or illiquid assets. This fractionalized ownership increases liquidity by making it easier for investors to buy, sell, and trade these assets, leading to more efficient markets. 2. 24/7 trading. Unlike traditional financial markets, blockchain based tokens can be traded 24/7, eliminating the need for intermediaries, reducing transaction costs, and increasing access for global investors. The round the clock trading enables faster, more fluid markets that are not bound by geographical or temporal restrictions. 3. Fractionalized ownership. Tokenization allows for the subdivision of assets into smaller, more affordable units. Thus, high level assets that were previously out of reach for many investors can now be divided into fractions, enabling wider participation and democratizing access to investments. 4. Transparency and security. Blockchain technology ensures a decentralized, immutable ledger that provides transparency and security. Tokenization leverages this technology, making ownership records and transactions more transparent and auditable. It also reduces the risk of fraud and counterfeiting, thus bolstering investors' confidence. 5. Automated compliance. Tokenization platforms can embed compliance rules directly into the smart contracts governing token issuance and transfers. This automation ensures regulatory compliance, reduces administrative burden, and facilitates faster and more efficient regulatory audits. 6. Global accessibility. Tokenization eliminates many barriers to entry, enabling investors worldwide to participate in previously restricted asset classes. This increased accessibility can unlock capital, promote economic growth, and facilitate cross border investment opportunities. What are some use cases for tokenization? Tokenization has disrupted numerous sectors, offering innovative solutions to long-standing challenges. Some prominent use cases include: 1. Real estate. Tokenization enables fractional ownership of real estate, making it accessible to a broader investor base. It also simplifies property management, reduces transaction costs, and facilitates more efficient rental and lease agreements. 2. Financial assets. Tokenized securities represent traditional financial instruments, such as stocks, bonds, and derivatives, on a blockchain. These digital assets provide enhanced liquidity, transparency, and automation to the traditional securities market. 3. Commodities. Tokenizing commodities like gold or oil allows investors to own fractional shares in these assets, providing exposure to their price movements without the need for physical possession. It opens up the commodity markets to retail investors and enables more efficient supply chain management. 4. Intellectual property. Tokenization can protect intellectual property rights, enabling artists, musicians, and creators to monetize their work directly with their audience. It eliminates the intermediaries, reduces copyright infringement risks, and empowers content creators with more control and revenue. 5. Supply chain management. Tokens can represent physical goods in supply chains, facilitating traceability, authenticity verifications, and streamlined logistics. This technology enhances transparency, reduces counterfeiting, and improves efficiency in industries like food, luxury goods, and pharmaceuticals. So, in conclusion, this course on the Introduction to Tokenization provides a comprehensive overview of the concept and its applications. It explores how tokens are created, exchanged, and managed on blockchain platforms and highlights the potential benefits and challenges associated with tokenization. Now that we've gotten that out the way, let's talk about commodities versus securities, the differences and implications. Commodities and securities are two types of financial instruments that play crucial roles in the global economy. While both serve as investment vehicles, they have distinct characteristics, regulatory framework, and implications for investors. Understanding the differences between commodities and securities is essential for individuals and organizations looking to engage in tokenizations, initial coin offerings, ICOs, and navigate federal regulations. This topic explores the disparities between commodities and securities, highlighting their implications within the context of tokenization and ICOs. Number one, definition and characteristics of commodities. Commodities are raw materials or primary agricultural products that can be bought and sold in large quantities. They are fungible, meaning that individual units of the same commodity are interchangeable. Some common examples of commodities include gold, oil, natural gas, wheat, coffee, and livestock. Commodities are often traded on specialized futures exchange, where standardized contracts facilitate their purchase and sale. Characteristics of commodities include physical existence. Commodities have tangible forms and existence in the physical world. For instance, gold can be held in the form of bars or coins. And then there's limited variation. Commodities of the same type have relatively little variation in terms of quality. For example, a given unit of wheat is similar to any other of the same grade. It's just wheat. And then there is price transparency. Prices of commodities are usually readily available and widely disseminated. They are determined by global supply and demand dynamics. 2. Definition and characteristics of securities. Securities, on the other hand, are financial instruments that represent ownership or creditor relationships with an entity, like a corporation or government. They are typically issued to raise capital and traded on regulated markets, such as stock exchanges. Securities can take various forms, including stocks, bonds, and derivatives. Characteristics of the securities include abstract representation. Unlike commodities, securities are not physical assets, but rather abstract representations of ownership or debt. For example, shares of stock represent ownership in a company. And we have diverse variations. Securities can have different classes, options, and terms, enabling investors to choose from a wide range of investment opportunities. Lastly, regulated trading. Security markets are subject to regulatory oversight to ensure fair trading practices, disclosure requirements, and investor protection. And point number 3, legal and regulatory frameworks for commodities and securities. The legal and regulatory frameworks governing commodities and securities differ significantly due to their distinct characteristics and historical evolution. So let's talk about commodities first. Commodities are primarily regulated by the Commodity Futures Trading Commission, CFTC, in the United States. The CFTC ensures fair trading practices, market transparency, and protection against fraud and manipulation. Additionally, exchanges and self-regulatory organizations play a role in overseeing commodity trading. And then there's securities. Securities are subject to extensive regulation, including the Securities Act of 1933 and the Securities Exchange Act of 1934 in the United States. Authorities such as the Securities and Exchange Commission, SEC, oversee the issuance, trading, and reporting requirements for securities. Compliance with securities laws is crucial to protect investors and maintain market integrity. Last but not least, 4. Implications for tokenization and ICOs. I just want to give a valid point, guys, before I touch on this. It's in my mind. When you hear the words crypto and you're thinking about SEC and regularization and ICOs and tokenization, this is what should be in the back of your mind. Before you make that investment, please, please, please do your own research. And that's all I'm going to say about that. Moving on. 4. Implications for tokenization and ICOs. Okay, let's go. Understanding the distinctions between commodities and securities is particularly relevant in the context of tokenization and initial coin offerings, ICOs. Tokenization involves digitizing assets and representing them as tokens on a blockchain, whereas ICOs are fundraising mechanisms where tokens are sold to investors. So when it comes to commodities, while tokenization of commodities can offer benefits like increased liquidity and fractional ownership, it's also vital to consider the regulatory aspects related to commodity trading, such as the CFTC's jurisdiction. And then when it comes to securities, if tokens issued in ICOs represent ownership in a business endeavor or derive value from an external enterprise's efforts, they might be considered securities. In such case, compliances with security regulations becomes crucial, including registration or exemptions from registrations under the Securities Act. Again, make sure you are doing your own research before you make any investment in any type of anything. Whether it is a security or a commodity, if you're not even sure about that, then maybe don't make the investment until you know. So, in conclusion, the course on commodities versus securities, differences and implications, provided a comprehensive comparison between the two of the financial assets. It explores the characteristics, regulations, and market dynamics that distinguish commodities from securities. Now, we have had a deep dive into securities, commodities, and all things awesome. That leaves us with understanding more about ICOs, the initial coin offerings. What are ICOs? Initial coin offerings are fundraising methods utilized by companies or projects in the cryptocurrency field. Similar to initial public offerings, IPOs, ICOs allows companies to raise funds by selling tokens to investors. However, unlike traditional financing methods, ICOs typically operate on blockchain platforms, and the tokens being offered are usually associated with a particular project or ecosystem. So, how do ICOs work? Well, ICOs typically involve several key steps. So, let's go over a few. 1. Project development. The company or project seeking funding outlines its objectives, roadmap, and key features of the product or service being developed. 2. Token creation. The company creates a digital token that will be sold to investors during the ICO process. These tokens usually serve as a specific purpose within the project's ecosystem. 3. Marketing and investor outreach. The project's team markets the ICO to potential investors through various channels, such as social media platforms, online forums, and dedicated ICO listing websites. 4. Token sale. Once the ICO is launched, investors can purchase the tokens using fiat currencies or other cryptocurrencies. Typically, a set quantity of tokens is made available at a certain price, often with discounts for early participants. And 5. Token distribution. After the ICO concludes, the company distributes the purchased tokens to investors' wallets. These tokens can be traded on cryptocurrency exchanges, held as investment, or used within the ecosystem of the project. So, what are the benefits of an ICO? ICOs offer several advantages to both the company and the investor. Access to capital being one of them. ICOs provide startups and projects with a new and efficient way to raise funds, allowing them potentially to bypass traditional funding sources like venture capital or bank loans. And there's 2. Global reach. The nature of blockchain technology and the internet allows ICOs to reach a global audience of investors. This global reach helps bring investment opportunities and enables individuals from different countries to participate in funding innovative projects. 3. Liquidity for investors. Tokens purchased during ICOs can often be traded on cryptocurrency exchanges shortly after the ICO concludes. And then there's 4, the incentives for the early adopters. Many of those participants have early access and discounted token prices or other rewards.